Well, hello, everybody. I am Gary Hamill. I am here with my colleague, Michele Zanini. Welcome to the New Human Movement. Today, another amazing guest, Brian Moynihan, is the chairman and CEO of one of the largest and most influential financial institutions in the world, Bank of America. By the way, I'm a customer for more than 30 years. Bank of America has more than 200,000 employees, roughly $3 trillion of assets. And Brian has been leading Bank of America since 2010, so in the wake of the financial crisis. And he's also been working hard to instill a culture of responsible growth. And Brian's influence goes way beyond Bank of America. He's been playing a leading role at the World Economic Forum, the Business Roundtable, other institutions to really get businesses focused on a broader social agenda. And B of A has definitely been out in front on that. They've moved all of their U.S. associates to a $20 minimum wage. They're making significant investments in minority-owned businesses, historically black-owned colleges. They've put attention on building a highly diverse leadership team and board. And I think it was last year, Brian, they launched a $2 billion Equality Progress Sustainability Bond. And you can find out more about that online. So, Brian, thanks for your leadership and welcome to our conversation today.
Well, it's great to be here, Gary. And Michele, thank you for asking me to join you. It's exciting stuff.
So let's dig in and let's no softball. Let's just go right at it, Brian. So capitalism in a sense is in crisis, right? You could argue that maybe it's slowly losing its license to operate, and the data is kind of sobering. Edelman's big global survey says 56% of people now think capitalism does more harm than good. In the United States, only about 25% of people think capitalism is working for everybody. In another big global survey, more than half of those surveyed said businesses and government and media are now they're run for the benefit of the few rather than the many. So how did we end up here? What's your kind of diagnosis about why business or why capitalism itself has lost its credibility with so many people around the world? And then we'll talk about solutions, but maybe a little diagnosis to get us started.
Well, I think one, it's just ensuring that the key is to ensure that capitalism is aligned with what society wants from it, and that's really the simplistic way to think about it. And then capitalism done right will actually get things done and provide benefits. And so let me just step back and the case for capitalism has to be made that it is the only system that's going to provide the dollars, the talent, the incentives to get things done. But you have to deal with what the outcomes are and handle them. And the question of that balance is often talked about. So it actually, the World Economic Forum, Klaus Schwab 50 years ago, the Davos Manifesto, stakeholder capitalism, and then 2015, the UN, we have a catchphrase in our advertising called "What would you like the power to do?" And so it's as if the world was asked the world, what would you like the power to do? The UN did, and 195 countries signed up to the Sustainable Development Goals. And so your thought would be, if we develop capitalism along a dimension that delivers on the SDGs, it would be hard to argue that that's not capitalism done right. The problem is, that's an interesting statement, but how do you figure that out? How do you measure it? How do you get there? Meantime, you had the huge amount of ESG investing. Meantime, 2017, a bunch of executives at the WEF say we sign on to help drive the SDGs. Meantime, 2019, the BRT says, move away from stakeholder primacy to broader shareholder primacy to stakeholder capitalism. We have all that swimming around. And what a group of us realize is we have to have a way to define it, because we have to show capitalism is aligned. And so that's where we did some work on metrics. But the important thing is, why do we do that? It's $6 trillion a year to do the SDG implementation.
So, by the way, SDG, Sustainable Development Goals, right? Just so I got the mnemonic. Okay, yeah.
195 countries said this is what we're going to do, Gary. And so $6 trillion a year, all the charity in the world, and it's wonderful. And the 80% of its United States citizens giving them money away to charity. All the charity in the world is about $1 trillion a year. All the endowments, and there's been a movement, take all those endowments away from these universities, like some of the universities you're affiliated with, and go spend it. Well, that's about $1.5 trillion. Well, then you're out of money, right? And then the governments are running significant deficits. So the only way to really get the activity taken is to align capitalism to drive it, delivering the SDGs. So it's what we call the genius and, deliver for the shareholders and for society. And that's simply how you get there. If we do that, irrespective of how we got here about capitalism, and I've been asked in front of Congress by people on both sides of the aisle, are you a capitalist? Which is kind of interesting because you run the biggest bank and its whole purpose is to help capitalism take hold and questioning. And I said, look, it's of course we're capitalists. This is what we believe is the right system. But if you think about what I call the killer bees of capitalism, Bono says capitalism has to be tamed. Buffett says, capitalism is a great system, but you have to deal with the fallout. Benioff says capitalism has to be driven. Bloomberg, capitalism has to align with the environment, which is his particular things. All these people have views that are absolutely important to understand, but it's all about aligning capitalism. That's what we try to think about with the SDG alignment with the metrics and things like that. And capitalism done right meets the Pope's demands, meets all the Judeo-Christian history demands, and meets what society wants. So I don't know how we got here, but this is the way we get out of here, is to show capitalism aligned right delivers for society, profits and purpose.
One of the things, and so here's a proposition, Brian. You can correct me. There's been this debate, I guess, in some quarters about, like, are corporations really people? Do they have inalienable rights? And what I hear you saying in a way is no, that these institutions are chartered by societies to do things, and that society can rewrite those rules or change the expectations, and we're in the midst of that kind of renegotiation right now. Is that a fair thing to say?
Well, and also, though, think about long-term brand. If you have a big consumer brand like Bank of America and you're out in every other household and your products aren't fair, or you're not supporting the communities, or you're not doing your part to support small business lending, you pick the topic. Do you think your brand's going to survive through time? And so that's the pitch to the management and boards of these companies, is this alignment means your brands are more resilient. Your work on climate is critical to your customer base. Your work on human capital is critical to your customer base, and the topics we'll get into in some of the human movement questions and thoughts. But these are also critical to your long-term brand success. So, and even if people who studied Milton Friedman a lot more than I have would go back and say he actually contemplated all that, is what he said. It's just the emphasis got on one part of the sentence, not the other part of the sentence. And stakeholder capitalism by cost is just the emphasis more balanced between the two parts. And that's what we call the genius of the
So,
and.
Brian, let me
And
let me
so I
ask the
think
question. As you talk, I mean, you're so densely connected into CEO networks. The work that you're doing through the International Business Council, we'll come back to that. 160 CEOs plugged into the World Economic Forum. How, when you're talking to other leaders, how do you distinguish? And just give me a minute here. How do you distinguish between somebody who's like going like, okay, yeah, I got to do this, but like, let me do the minimum necessary. Let's do some woke washing and then be done with this. All I have to do is, like, make sure I meet the diversity targets. I really don't have to empower the people who work for me. How do you tell whether somebody's all in with their heart, or whether this is kind of another PR exercise? What do you look at?
the area where you hear most about this today is obviously the greenwashing side of it, which is, companies are saying they're doing this and they're doing that. The reality is there's a transition that has to take place, and that's where I think all CEOs agree. Even the companies that are in the toughest things, an energy company agrees, I've got to make a transition. You're hearing them make those transition announcements. So in my view, there is a minimum standard, Gary, to your point. You gotta acknowledge that we have to make a transition. You got to show us your pathway. Then as a lender, as an investor, as a contractor with the party, they're in our supply chain, we can stay with them. But if they don't show us any progress, now your point is, how do we make sure they're making a genuine effort? Well, if they say this is my plan, and in year two they don't make progress, you can look at it and say you didn't make progress. Obviously, the plan was, greenwashing, whatever the right terms. But I think we have to let people go and start to take the activities. But they have to. That's where the disclosure and the metrics come important, because it says here's the progress I'm going to make, and we can hold people accountable to a level. Then people may fight for brand benefit and customer benefit by being different places on that curve of, the best company to the companies just above the bar. But all those companies, you ought to say, are investable. The companies below the bar, because our research says that they're going to fail at a much higher rate than the rest of the companies. And if you don't invest in them, you avoid 90% of bankruptcies. Therefore, if you don't lend to them, you can basically make that's a pretty provable case. So you're saying to investors and people, stay away from those companies. By the way, the employees won't want to work there, et cetera. So the question of bar is not greenwashing. That's getting you the level. After that, I think the competition among ingenuity and creativity becomes more important. But if we don't get everybody over the bar, we're not going to make the progress on the environment. We're not going to make the progress on the opportunity for uh, Hispanics and blacks and women and other ethnicities in America. We're not going to make that progress unless everybody gets to bar, and then we can work from there. And so some countries will be way up above that bar, but if they don't get a minimum bar and they don't disclose that minimum bar, you'll never be able to get by. Oh, it's just announcements. It's just PR.
Yeah, I mean, one more question, then I'll turn it over to Michele. I would like, if you're willing, I would like you just to reflect a little bit on how we got to where we've gotten. Because what I hear, I hear a lot of the debate, which still seems as if to say that the diversity agenda, the environmental agenda, the social agenda is something that is in addition to taking care of shareholders. That these are somehow fundamentally in conflict, and that over the long term, I can appreciate they may be in conflict, but they're in conflict. And now, we're going to worry less about using society's resources really wisely, which is measured by profit. And we're going to worry about these other things. And I sense that's what happened with the shareholder primacy. The leaders I've admired through my lifetime, people like John Mackey at Whole Foods, John Ferriola at Nucor, Richard Branson at Virgin, Jim Senecal at Costco. These individuals never saw shareholders versus employees versus doing good. And these things are all together. But it's like I'm just kind of like perplexed on why did we suddenly need to take this deep breath and say, oh, gee, we got it wrong? And I wonder how much of this was just like poorly designed CEO compensation packages where we said, we can't hold more than one idea in our head. So just go for, we're just going to measure on EPS growth. And by the way, if that means buying back your own shares to change the denominator, that's okay. I mean, because I worry that if in the past we've had a hard time holding more than one idea in our head, like how are we actually going to master now the complexity of this? Because what you're calling for is a very multidimensional set of measures.
I can flip that. So a little bit was companies like you mentioned, and many companies, and I think our company and our industry, frankly, had a community purpose from its first day. In 1784, when the oldest part of our company started, it was built to fund the projects and capital development of community, and they have, and it happened to be in the Massachusetts community, but like banks start all over the place and end up in this big thing we call Bank of America. And my colleague banks have the same thing. So I think, we all are products of the community and the economic. We're all economic engines. We sell products, we sell services to other businesses, whatever. And they're all linked together. There's very few pure small businesses. In other words, there are small businesses which sell to big businesses. Very few could stand on their own and have nothing to do with anybody around them and survive. Maybe a plaintiff's law firm, maybe a solo practitioner, doctor, or something like that. But even they would be driven by medical premiums we pay. So the end of the day is sort of, you sit there and say, so it's all a big ecosystem. And I think what happened is a lot of us were operating in companies this way, and yet we're being subject to criticism on shareholder primacy. And I think the BRT really modernized its statement to be more in line with actually the memberships, how they're running the companies. So this is not, to your point, this is not a new concept. This is a concept which has been around. It's not we got to go from, it's not a 1-0 switch. It was to say this is how we're going to run them. But it was against a backdrop where we were more challenged to prove in a world of opportunity not being fairly distributed in people's minds in terms of resources and compliance and tax payments and the housing bubble in the United States. You pick your topic. In a world of all that, I think it requires us to remind people of the good that large companies do. And we employ 200,000 people. We actually insure 700,000 human beings, and take care of their medical service. And we, have an impact beyond that. We hire 17,000 people a year. It's a modest turnover rate, but 8%. So 70,000 people come in. That's a big impact on the communities. And so I think how we think of that. And then the other thing I think that CEOs have taken on a lot more responsibility because they didn't see stuff getting done. About 10 years ago, we started saying stuff is getting caught at the federal levels across the world. So you may have been in some of this BRT WEF discussion. So we started having mayors come in and say we can do programs of mayors. And same time, the BRT was kind of getting the same place. And the other thing was we said, look, local groups of business leaders can actually do more for job training, job skilling, providing opportunities than we can by any sort of top-down fiat. But that's all local. It goes a little bit to the themes of human. And so I think we recognized we had to work together locally to make impact, or else because we were global, we were doing a little bit everywhere, and everybody was doing a little everywhere, but it wasn't adding up to enough. So I think it's awareness. I think it's accountability. I think it's the investors in the community that supports those investors, i.e. the people getting the money to invest. I think it's our customers. And I think the lead is environmental, and the second part of it is human capital, but it does reach other things like governance and things like that. But the real depth of discussion is a lot around those two pieces.
So, Brian, I wanted to go back to a topic you've alluded to a few times already, which is the work you led at the International Business Council of the World Economic Forum, which was really focused on developing a set of shared metrics around four pillars, if I recall correctly: governance, planet, people, and prosperity. And so, I'd like to kind of unpack that a little bit with you, and maybe we can just start with, the origins of this, because obviously the report came after a lot of work that I'm sure wasn't very easy, of corralling a lot of different stakeholders together and to define, the shared vision and these shared metrics. But what motivated it, and like what did you and others see that was missing in this kind of landscape of metrics and accountability, given the fact that there are quite a few other standards, right, of reporting and metrics around some of these topics?
There was nothing missing in terms of numbers of standards. Matter of fact, it was a polar opposite. There was more and more and more. And when it hit me hard was sort of a couple different events. One, we had a lot of shareholder engagement 2015-16 to really understand what shareholders were thinking about core corporate governance, because we'd had this thing where we put together the chair CEO, and then we went out to the shareholders and had to approve it, which is a very unusual thing, to actually go for an approval and get it done. At the same time, you had to say on pay votes, and we're 95% every year, and you're saying to shareholders, what do you mean by this? And so there was a lot of that dialogue that was coming out. So just basic sort of shareholder engagement was leading to dialogue. The second thing is, as the environmental demands and we need to make progress, and we can't keep pushing the can out, I and others and many others would go to these sessions where there'd be one CEO, one person running a company, and 25 people covering the set of discussion panels during the day. All 25 are saying, let's debate about the right metrics, with one poor person's actually got to do it. And I said, wait a second, we got to flip this around, because they're all right. But the problem is to comply with all the metric setting and keep sending in more information, whether it was TCFD or PCAF in our world, and then GRI and SASB, and every day it was another set of metrics. And so we said, wait a second, let's try to get them to converge. In other words, the metric setters to converge and us to converge, to get to an agreed upon set of metrics. And for the benefit of both of us, that one, we don't spend more time trying to figure out how to supply the information on metrics or argue about the relevancy or get into that, is let's agree to something, get it done. And by the way, we will improve them. There'll be a living, like the accounting text doesn't change all the time. So that was another convergence, was so many people setting, and like we didn't suffer for lack. We call it the alphabet soup. I used that word originally. Now it's quite, maybe I wasn't the only person, but I started using it. Now it's quite out there. I heard it from someone today that surprised me. But and so we said convergence. And so what we did is we went to the big four accounting firms and said, study all this and come back with what you think companies can do. Because we also had to say to the issuers, you can do this. So CEO says, yeah, we'll do it. And then, of course, CFO says, oh, my God. General counsel says, liability, we can't do this. What happens? We said, look, if we get your accountant's degree and the lawyers working with them and stuff, it's a little hard to say, do it, and 70, 80 companies have signed up. So it was all those convergence of more metrics and just more and more people saying this is the proper metric, largely around the environment, largely incapable of being supplied, and all the energy in all our companies was going to the metrics discussion, as opposed to let's go actually do things to make a change happen. And that's where we kind of came to the conclusion, we got to flip the dial here and try to come up with a set of metrics that our investors will agree with. The metric setters will agree on relevant metrics. By the way, we use TCFD as one of the incorporated metrics, so how could they disagree, right? I mean, at the end of the day, you said, yes, we agree with you. We're going to put it in here so it has relevance with others. Worked with GR SASB and Janine and the team in SASB, and they're very good, and they're trying to get them, and then you're getting them to converge, and all will end up with somewhere, and the IFRS is pulling in an official record segment, and these are all good things. And so, but it was really out of I wouldn't say a frustration, but a realization that the alphabet soup was expanding. There were 500 conferences, I think, that were supposed to be had in 2020 that maybe didn't have because of COVID.
Well, yeah, and we're trying to familiarize ourselves with this space, and it does sometimes hurt your head when you look at these matrices in like 5-point font where you have hundreds of indicators and different weights for each. So I can imagine that a CFO or even an investor's head would explode. So I guess what you did, which is, yeah.
Remember, we want to show we're making the progress because we want investors to support us. And if somebody else who's in our industry is not, they should pull the money out of them because they're going to have trouble, and they should put it in money in us because, to Gary's point, the brand, the reputation, the compliance costs. What you pick your thing, the diversity of thought, the innovation that comes from having that and understanding markets that are changing dramatically. It isn't going to happen unless you do these things. So the point was, we agreed that we had to have metrics, but we also agreed that if capitalism to get the Edelman barometer to go the other way, you're going to have to show people what capitalism does. And to have a demonstrable set of things, everybody agrees these are measurement, and you say, okay, our level 3, our scope 3 emissions are X, and they go down to X minus something, X minus something, then people can say, hey, it's not greenwashing, they're making progress. So that's we needed them too to show capitalism done right is the right thing.
Yeah, well, what I'm also taking away from your account is that it took a set of leaders like yourselves and your peers to say, okay, guys, we have this alphabet soup. Let's just get this down to a basic number of things that we all agree on, and then let's use that as a scoreboard, right? And it just wasn't something that would happen on its own. And I think that's a very instructive. Now, I remember that for each of these 4 pillars, you have a set of metrics which are core, and then a set of metrics which are kind of enhanced, which is, I guess, maybe the next level. I'd love to get your take, and maybe pick a couple of the pillars, maybe purpose and people, for instance. And what are you think the most relevant, no, the most powerful metrics? So if you had to condense that even further, that list even further, which ones would you pick?
Well, if you're on the human capital side, the core diversity at all levels in the company shows a business system that produces opportunity coming in and opportunity through the ranks, and also an ability to develop and retain people of all different cultural backgrounds that has to work, or else you couldn't get there. In other words, and so the improvement year to year, and that's a powerful metric because it shows that we are companies of opportunity, that anybody can come here, whether, and by the way, economic strata or ethnicity or whatever, and they can be who they want to be and get through it, because you might be able to hire a lot, you wouldn't be able to have it go through the system unless your system was fair, equal pay for equal work, and those things. We also have equal pay for equal work in there, which is another critical one, to make sure it really is a nearer term, that you're not going to wait 10 years and find out that didn't work because people thought they weren't getting paid. And then we have training. And so those are 3 pretty good metrics on people that you kind of look at. Now, are there 45 other ones we could have? Sure. But those 3 or 4 are sort of saying that's the core sort of health of the organization. If people are attracted to you, if you train them well, if you pay them fairly, and they end up progressing and populating the whole company, you got to have a pretty attractive culture. And so we can come back and talk about how it fits in some of the ideas of how you have organizations run from out in and all that. Those are very important things, but none of that will happen if you don't have the people coming in. And so I'd say that's an example of how those 4 simple metrics actually can be a pretty good indicator. Now I can come up with, matter of fact, I have reams of paper like this about all the movement of employee metrics and stuff like that. But that's for me to manage a company. But you to look at it from the outside, you're saying if you can't get to the representation, this is the United States question in particular, because other countries are harder to do this in, the representation of society in your company, when schools are taking in above that representation, and your initial hiring is above that representation at your senior levels, something's going wrong in the process. So you're not a company of opportunity, and your brand's going to take problems, and your innovation is going to have problems. So those are kinds of ways we think about it. So we try to be simple, and I agree. Everybody's going to watch us say, I have 5 other metrics that are important, and believe me, there are 5 other metrics important. I'm not discounting that, but you got to start somewhere, and you got to have a way I can look at every company, so that your representation of your board of directors from a governance in terms of diversity, what you do on taxes, it was a controversial one, because think about it in the world we're now, what's your tax rates and things like that. Those kind of say, hey, we're paying our fair share around the world. We're not, and those are interesting things that gave people pause.
I hope you're enjoying the conversation, and there's a lot more to come. I just wanted to take a moment to thank Hire for supporting the work of the New Human Movement and underwriting the costs of producing this video. Our goal is to spur a revolution in leadership, organization, and work. And in that endeavor, Hire has been an extraordinarily reliable and inspiring partner. Now, back to our conversation. So Brian, let me, you talk about the kind of size of the challenge, and you have to start somewhere. And so let me ask what in a way is an unfair question. I'll preface that because, you know, a leader only has so much time, and you've invested an enormous sum of your personal capital in pushing business forward on these things. So this is not directed at you, but it's kind of a more general. What I'm always trying to think about is what do CEOs don't want to talk about, right? What's the next agenda that we should be thinking about? And let me throw some things out that because if you unpack this problem we're having with capitalism, and digging out of that hole. Certainly, some of it is about diversity, everybody having a fair shake in an organization. Some of it is about organizations caring about the planet. But I think there's a whole lot more than that. As I said, 82% of Americans think large corporations are now too powerful. And so I wonder if there are other things we have to be talking about, like what is the share of national wealth of GDP that goes to profits versus that goes to
Right.
employees? And what we've seen is the share that's going to employees has kind of flattened out, and the part that goes into profits has been going up and up. And while like the investor and CEO class has done really well, everybody else not so
Right.
well. So huge issue
Right.
of income inequality, which I think is probably even more fundamental in many ways than some of these other issues. Number two, you think about the share of corporate profits today that comes from regulatory rent seeking. And James Besson at Boston University says about $400 billion a year goes from consumers or from business from consumers to business who take advantage of the regulatory environment to keep new entrants out and so on. Most companies can't afford a huge compliance department. Or you think about the impact of corporate concentration on prices. There's a lot of research right now that says how concentration across a whole set of industries, like for example, mobile phones, has raised prices. We were talking to Thomas Philippon about that, a wonderful author and thinker. Or the percentage of share options that go to frontline employees. In other words, I think when you start to peel this onion, the diversity thing may be a down payment, the environmental thing may be a down payment, but it seems to me there are other metrics we need to be
Sure.
thinking about, and there are other things we need to be worrying about if we want people to believe that like this works for everybody.
Yeah. So that's not an unfair question. It's a lot of questions, but
Yeah, sorry.
it's not an unfair one. So let me just talk about running a company in the world we are in now and thinking through, which is we have to be a company of opportunity. In other words, we have to bring, for our clients and what we do for them, whether it's individuals or companies but also for our teammates. And that's all levels. And so I think, we did some interesting things, and part of it was prompted out of regular things were going on. So on our healthcare benefits, for example, when I took over as CEO, the management team took over. It was the early days before the Affordable Care Act in the United States, and all our people paid the same. So everybody paid $500 a month for family coverage, which is kind of the number. And so when the Affordable Care Act came up, if you remember, Gary, in some of the early provisions at Michele, there was a thing about how much of your salary you could pay for healthcare premium, right? We're self-insured, so it's all our money, but the employee contributes and we pay the rest. We spend $2 billion on healthcare. We get about $600 million from the employees in reimbursement. So it's $1.5 billion of net expense. So we took a look at that. And what we said was, irrespective of the legislation, what would happen? They're right. Everybody shouldn't be paying $500. So we dropped the $500 in half for people under 50,000, and we have never raised their amount of contribution for 10, 11 years now. Now, that's just an example of looking at, you're really pointing out the equity question, for lack of a better term. So what we said is, wait a second, $500 a month for family coverage doesn't sound unreasonable, but it's $6,000 for a person making $50,000. That's that percentage of a person making $500,000. So we just basically said, well, how do we make that up? We took the other upper levels up. So it's basically a 50-50 share. We pay half and the employee pays half. And down at the other, it's a 10% share. And we've held it flat, and we've absorbed all the costs for everybody, at least a 2 to 3%. And for that group, 6 or 7%, you pick your underlying trend. We just recently looked at childcare the same way. So during the crisis, we gave $100 an hour to everybody. First, everybody. If you made $2 million a year, we give you $100 a day, to hire people to come in your house and take care, because childcare, schools were all messed up March of last year. Then we graded it brought it down because people making a lot of money and things were opening up. But what it causes us to do is go back and look at our real benefit, which hadn't been raised in a while, and said, wait a second, let's do that on a per we took a per child benefit up another notch for people under a certain amount, so it's $275 a month per child, which then says somebody has 3 kids who's making $60,000-$70,000. This benefit is actually a substantial capability for them to have the kids in childcare, et cetera. Where before it was more of a standard benefit of X dollars per month. And so looking at things that way, your wage, if you look at our wages and salaries, people working in the company that started under 50,000, doesn't mean they are today, have had an annual increase of 10% per year plus for the last 10 years. By the way, that holds true all the way up to 500,000. And so how did we do that? And this is going to go a little bit to thing. We engineered the efficiency of the company to pay for that. So the overall compensation levels of the company are flat to down. The numbers of employees are down, and all the people are getting paid more, and the benefits cost us more, but there's less people, less work, and then we let attrition do it, so we didn't have to lay people off, and then we're redeploying, reskilling people to cover it up. So there's ways that you can think about that equity fairness dimension, and I think a lot of companies are thinking about that now. So not only is it diversity of representation, it's also how your policies impact different groups of people that was unknown. So everybody got worked up about childcare, but they forgot about elder care. Elder care is a big burden for a different spectrum. So we extend all those benefits to elder care and things like that. And so it's really sitting down with a group of people, and we have a diversity inclusion group in the company. It's very powerful. They have 170,000 people in networks and you ask for their input, and they're giving you their input, and then you got to figure out what you can do about it. And then you got to say, hey, look, the people making more money, you're going to have to carry more of the weight to supplement. And by the way, we have to think about it through the lens of the teammate. And I think that's what happened. So I'll tell you, you mentioned share buybacks, and this is a pet thing of mine because in our industry, we're not allowed to make acquisitions. It's been outlawed for 25 years because of our deposit share over 10%. So I only have two choices of capital. I give it back in dividends or I give it back in share buybacks. We don't buy back share. We buy back shares because we just have excess capital. We can serve our client. And so, but when people say, well, you should spend on your employees, so our minimum starting wage has gone from $10 an hour to $20 an hour, we'll go to $25 an hour. The benefits I just gave you. We got a 401k with 7% match. We got, what more would you say do? Oh, that's great, but you shouldn't buy back stock. I said, guys, that's not what the question is.
Well, you may have particular constraints, Brian. The thing that probably drives me a little crazy is when I see companies in very high growth industries. Let's name names. Like see a company like Cisco that buys back tens of billions of dollars of their own share while ending up way behind on 5G. And you go like, well, like what happened there? So I wouldn't speak to your situation, but
the question of investing in innovation, we do a lot of, and we put $3.5 billion a year in technology initiatives a year. And if I didn't think, but for us, it's an expense question, not a capital problem. And it's unique to our industry, right? Our balance sheet's huge. We have $200 billion of equity. So our question is, how much can you afford to spend? So the capital is not the problem. It's actually literally the run rate expense, we're a little bit unique as an industry. But I've been trying to make sure people understand the distinction of what the issue you're trying to solve. If it's the amount of investment in, like you said, in technology development or something, we're at $3.5 billion. We doubled it. That's a lot, and we can't get a lot more done effectively.
Yeah. Well, and that's another point. If you look at companies that have no historic track record of organic growth and have missed a bunch of opportunities, it's probably better that they give that money back than they waste it. But Michele, sorry.
Yeah, no. So Brian, you mentioned the aspiration of creating a company that is a company of opportunity, which is fantastic. It reminded me of, words that we've heard from other CEOs of progressively managed companies. So, for instance, Jean Romain, who's the chairman and CEO of Haier, the largest appliance maker in the world, who says, he wants to create a company where everybody can be their own CEO, their own kind of entrepreneur, or John Ferriola, the former CEO of Nucor, who basically talks about the fact that everybody there is like a little business owner, and what they mean by that isn't just like rhetoric, but rather giving these people the tools, the commercial skills, the technical skills, as well as the latitude, right, the autonomy on the front line to make the right decisions, and then also that the in a way the skin in the game and the rewards, so that if they are adding value and creating a lot of productivity or profits, they get to share in those benefits, right? And it seems to me that, notwithstanding what you guys are doing at Bank of America, those kinds of practices, especially in services, but it's also true in a way in manufacturing, are fairly rare, right? That most jobs don't give you skills beyond what you need to do in that particular moment. You don't necessarily have a lot of autonomy. There's a lot of scripting and standardization that makes it hard for you to exercise judgment and authority. And the upside is, a couple of percentage point beyond like a fixed salary. It may be a little bit of profit sharing, but even profit sharing compared to even 50 years ago is withering. So I'm just wondering, because these companies are all very highly performing and successful, like why isn't this kind of human centric kind of focus, why isn't it more pervasive in corporate America?
Hey, Michele, let me just put a little data around that. And people who listen to our conversations regularly, they've heard some of this data before, so I apologize that to them. But the Gallup data says only 15% of employees around the world are engaged in their work. And in fact, Jim Clifton, who runs Gallup, who knows more about engagement than probably anybody in the world, like he said publicly, which I couldn't believe, he said the average CEO does not care about their people. That's like, I'm not sure he's right, but that was a pretty radical thing to say. But then you look at the data, only 1 in 5 employees believes their ideas matter at work. Fewer than 1 in 10 can experiment with new solutions, methods, and whatever. A tiny minority have control over their own tasks and time. And so, it does seem like we've locked up an extraordinary amount of human potential when you look at the data.
Yeah. So let's, I had the skills question, I had the comp equity sort of participation and things question. I had the idea generation, how you have employees and how you run a system. And those are very different things. So maybe we'll unpack them a little bit. Just on the comp and equity, frankly, this was something our industry got beaten up for options and all this stuff that would have done it. But we have now gone back to where for people really start $100,000 above, 10, 20, 50, 75% of your is all in stock. I basically have base salary, everything comes in stock. And so we created a lot of share ownership in our teammates over the time. And then we've done broad-based grants to the people, to teammates under 97% of teammates. It basically gave them first cash, $1,000, and then now give stock to a certain level. When you get down to people who get paid, 60, 75,000, 80,000, they'd rather have the cash, honestly, and because it's near term and it's good. So we think that's true, and we push for that. Now there's a limit to what I can do because of some regulatory stuff, but what we could do in our industry. But we agree with you. My view is, it really, Gary, the invert. We buy stock back from people who want to sell it, and we let the people who have the investment in the company get more of an investment in the company. If that is 7 to 8% the employees, think this is a $375 billion market cap, 360. So that's a lot of money in the hands of the employees. And by buying it back of other people, the employees' interest is going up over the years. And so that's one of the benefits that we have. So we're trying to do more with that. Let's go to skills, because this is, well, actually, let me go to the ideas and the point about engagement. So we take a survey every year. And what's unique about us is 98% of the people fill it out. And what's unique about us is we have longitudinal data that people would die for, right? 30 years of survey down to the granularity of things. You get about 100,000 verbatims every year. I read them all. It's interesting because that's where you get the, instead of the radio dots 1 to 5, that's you get the information. We use it as a practice to figure out what to do. But it's just a starting point always. It's always what are the themes of it, and we can cut it by ethnicity, by level in the company, management level in the company, and we look at it all. And we try to say what's the pockets. But then we go back, and I have a green belt, a Six Sigma green belt in associate survey practice. That's what I did mine in. And so we go back and say, okay, here's the data from my group, 10 people, 15 people, 20 people, 100 people. This is what you said. What are we going to do about it? So we've tried to get what we call simplify, improve, and new BAC, and all these names we use for idea generation and entrepreneurship out to the line, and use the survey as the anchor and said, you said this, what can we control? What are the ideas we're going to work on? And then what are the ideas we have for other divisions that they can work on? And so we've tried to use the survey a little bit, and our survey scores were all-time high last year. I mean, we were 91%, and which was a record for us. So that's good, but where's the ones you don't do so well? Everybody says, oh, RJ, please. I always go to the bottom 10 scores and always look at them and say, what are we going to do? Feel free to speak my mind without fear of negative consequences. My job, the work in my area is organized efficiently. All those places that that are, it's a bureaucracy. You go in and say, okay, go do something about that. I love the fact we got a good score, but what's that happening? Because that's the feel of the employee base. And so I think you can get that. So that we come back to that on a day. On skills, I think we are trying to hire. We changed our method, which was we could hire people and we could always get them, to we want to hire people into career. And so even our retail base, we hire people, train them on 4 or 5 jobs with a view that they could be here for the rest of their life. That has dropped our turnover.
Let me interrupt, Brian. I think that was a very important thing you just said. What triggered that switch for hiring people into a job and hiring them for a career? Because that's a fundamental shift in perspective.
We had to do it because the turnover just you were tremendously inefficient for turnover. And people, and that had to do with why we raised wages. We raised them because we think it's the right to do. We make enough money to go on all the sharing. We also did it because of practical realities is the turnover's dropped by 60, 70% in these high volume jobs, call center operators, branch employees, in over 10 years. Just think about the calmness of the franchise when you're not, and it was never, you didn't have 100 people, and if there's a 30% turnover rate, you know, it turned over 30 of those, 30, 60, 90, and had 10 left. What happened is the same 30 turned over and over. So so the idea was that we shut down turnover. The 70 that stayed with us for 30 years were great, and then 30 that stayed with us and didn't try. And so it was just business necessity.
Can I ask you, Brian, on that? Sorry to try to peel the onion a little bit further, because turnover didn't all of a sudden jack up, right? So it was fairly high for some time. So at some point, so someone at some point said, this is actually, if you do the math, it doesn't really work out, right? So like, why did it happen when it happened and not like before? Like, was it just happenstance or just was it you? Was it
two things? Your point about that dynamic was exacerbated the impact of technology, because the skills that you could hire and absorb the turnover. In other words, you could train people fast enough to competency, and then they could leave, are gone away. They're all done by the consumer with our digital platforms or automatedly. So when you start to think about that skill set that you could absorb high turnover rates and still have decent customer satisfaction. Now our customer scores have gone up from X, like 60% to 90% since then. So it's had an impact, but you could keep them pretty high because the tasks were so sort of trainable, for lack of that. Change my address, this stuff. That's all done for you now. So the tasks left are now complex. So what do you need? Experience and complexity. What do you need? Duration. What do you need? Life experience. If you can't make a mortgage loan unless you maybe been around long enough to have one, right? And so, so when you're talking to a customer, it's more credible. You said, I got a loan. I can understand the craziness of all the paperwork and everything. There's an element to it that's different if you've worked for 15 years for us, and then you come in and go. And so we recognize that the necessity was all the economics that you said, Michele. But secondly, is the task that you could train to in 3 months and get the person competent for 6 months, a year, and if they left you for 50 cents an hour, are gone. And then,
one of the things, I'm sorry, keep going.
Yeah, but then go back to the societal obligation that we all talk about is I feel we have an obligation as a company to try to reskill people, because otherwise, if somebody leaves us voluntary and gets another job in any place, I'm not happy about that. But frankly, they got a job someplace else. They didn't, but so we need to retrain some people so that given a 5% unemployment rate, 6% unemployment in the United States, the turnover we have is turnover that's going to work somewhere else for another company. I don't like it, but that's not bad. But if they're just being put on the street, shame on us as management. So the skills also absorb, the ability to not have those people just disappear as we do more. Going back to your point of ideas and engineering and entrepreneurship and frontline ownership of tasks and process and stuff. They're delivering us thousands of ideas a year to take out jobs, and the part of the quid pro quo is you won't lose your job because we'll train you to do another job. So give us more ideas so you can do the work you want to do, not the work you're doing.
The irony of that is that the companies that are the most eager users of automation technologies are the ones, as you say, Brian, that have almost like an implicit or explicit guarantee that people that come up with those ideas don't get laid off, right? I mean, it's pretty amazing because workers are probably the ones that have the most knowledge around what are the low-level value-added tasks that could be taken away. But obviously, if their job is on the line, they're not going to tell you. So anyway,
I have a friend, let turnover be your friend because of that. In other words, when I tell my business managers, if you take 8 or 10% turnover, which are some of these jobs like operations groups and call center, that is actually very low relative to the industry and relative to all industries. But 8% is still a lot of jobs. So if you're engineering out, what I think that's incumbent upon is get those ideas and build them in over time, and be patient enough that as they come in, you can we do headcount planning by month for 36 months out. So if I know a job's going away out there, I know that if I stop hiring somewhere along that line, I can actually size into that, 8 people, 10 people, 15 people in that unit of 100 or something like that. So it takes some pressure, but it took a complete reengineering of our headcount planning process to think skills and longevity. And the longevity is important because with time, I can train those, COBOL programs that do Python. I just have to take them off the line for 6 months and put them through the same online training course they take if we gave them severance and they went out, they'd say, I got to become a better programmer. They would just say, take them off the line, absorb it, and put them back. But I need to be planning ahead because I got to. So part of it's just good. I always say, team, this is what we get paid for, not the employees. We get paid to manage the human being impact of all this, change and dynamics.
This is a beautiful story, Brian. I love the way you guys are thinking about it that far out because the work we did with companies that really understand this, we profile them, several in the book, including a bank, Svenska Handelsbanken, which has outperformed all of its European colleagues for 50 years, is they understand that at whatever level you bring somebody in, whether they have a university degree or not, many of them, they will develop a level of sophistication thinking about your business. They will develop, and if you invest in their problem solving skills, and they will become powerful kind of engines of improvement and customer loyalty and moving your business forward. But most organizations, we ended up in this thing where we assume that like so-called low-skilled jobs are filled with low-capability people. And so you end up in kind of this self-reinforcing thing. We don't invest in them. We don't, they're not around here long enough to learn the business. We don't teach them how to think like innovators. Then they don't give us much, and we say, well, like we told you, and until you've done that, you never realize what is the latent problem-solving capacity of those people and how they can be useful to you, which is what you see it in Nucor and what you see it higher in some of these companies.
But
So
so what we can't. Every one of our branches isn't a profit center because it's too much outside of control. But every one of them can contribute to the effectiveness of the operation. It's not always just the efficiency; it's the effectiveness. What can we do for revenue? What can we do to customers? So that's that idea pull in, and you're trying to pull that in. And then one of the ways we make it happen is, out of that 3.5 billion, I'd pull 500 million out of the top and spend it nothing but what we call OPEX ideas. We call it operational excellence, right? And if I didn't do that from the top, what would happen is those ideas might die on their way to, I've got this product I'm trying to bring out. I've got this other thing. And Gary, to your point, you wouldn't embolden those teammates, the talented teammates, to come up with more and more. Let me go to a different point, a little bit on the skills and stuff. We started a few years ago and said we'd hire 10,000 people from the LMI communities, our branches, but we hired them in what we call pathways. We hired them in the career program. Now, what's interesting about that? You hire them, they come in and they work, and they start working for you to train them in the skills we have in our company, which are great skills because they could work at any bank, and there's tons of 5,000 market participants out there, so we don't have to worry about concentration in our industry. But there's 5,000 market participants out there. But importantly, we're moving around from job to job. But remember, we're doing $7,000, $8,000, $10,000 of tuition reimbursement a year type of thing. So if they come to and start working for us, and then go to the community college and take some classes or online take classes, that's a much better skills development because they know exactly what they need and they're not wandering around trying to develop the skills and then guess that we got it right. I found the skills at Bank of America hired me and said, no, we'll train you on, we're going to community college. We'll train your kids on call center capacities. They come in, they make $40,000 a year the first day. Then they have $7,000 to $8,000 of tuition reimbursement they can spend on their career development. And we're developing inside. And we're training for these jobs. Well, that's a different place. So when that kid goes from 19 to 24, what they don't do is trying to work a lot of jobs to get their skills. We're giving the skills, or we're frankly providing the engine of economic engine to get them the skills, both in core pay plus benefit. Now our view, and by the way, a lot of my CEO colleagues think the same way. That will then sort of truncate the people who go through 4 or 5 years and never get attached to the career. And that goes back to the basic bit. We realized 10 years ago, we had to stop the turnover, everything that Michele said. And then about 7 years ago, we said, oh my God, we got to show these people a career path completely across country. By the way, the college kids too, or else what happens is, and we have some locational issues that we have to deal with and everything, but we have to show people a career because we need them to stay with us. And that is a psychological change about skill development and career development and other lines of business in a big company like ours. So you go from wealth management to consumer and back and forth in commercial banking. We can't have people go up because we just lose them.
So, Brian, one thing that I'm very grateful you brought up is the notion that, I mean, you brought it a couple of different examples, that to change things, to really move the needle, you need to re-engineer the management processes, the core gears that run the organization. So you mentioned, carving out a piece of OpEx so that, it could get allocated to meritorious ideas that come from all over the company, or the way you have to re-engineer manpower planning, right? And that's very much our belief as well, that, unless you change those things, then, maybe some of these initiatives might, happen because the CEO really has a lot of willpower, but it's, they may be transitory, right? Because the CEO leaves and then there's nothing that kind of keeps them going. And so my question to you is that realization that you need to change fundamentally the workings of the organization to make these kinds of things happen, is that something that you think is there's more awareness of, that your fellow CEOs understand, and that as you say, their role is to become like the architects of the, in a way, of the management model, as much as, architects of the business model?
Yeah, I think the management model is where we focus a lot, and we realize, Ram Charan, who you guys have known for years in the management terms in the early papers about a manager, a producer, manager, producers, a manager, producer, managers, and then a unit manager. So we started really think about this, and this is more recent because let me give you the broad history. We had 280,000 people when I became CEO. We went up to 305. We're now at 210. About 6 years ago, I looked at it. I said, something doesn't feel right here. The compensation for the entire population of people at our company for a quarter was the same as it was in 2009 second quarter as 2015 second quarter. We had 285,000 people. We had 240,000 people. He said, something doesn't make sense here, because we're doing all this work, but we're not getting the benefits for the shareholder. And so what you saw is we had 30,000 managers, and they come down by about a third, and the employees would come down, or by about 20%, and the employees would come down by about a third. So he said, we got a problem. So we just put sunshine on it. And we went from 30,000 managers to 20,000 a day. And just by saying to people, this doesn't seem 13 layers to 7. So in that, obviously, is diversity moved up the chain, because the diversity we've been hiring at for years came through the top, so that got better. Opportunity got better. Everybody that leaves as a manager, we basically say, take the job and divide it among other people and promote them and give them more money. And so we've been able to run the company on the same level of expenses now in 2021, even with COVID expenses, as we did in 2015. Think about that. We're a much bigger company, much more activity, same expenses. Now, we have 30,000 less people. But what we've done is been able to invest in people's development, careers, turnovers down, all the stuff we're talking about. Then it came down and said, wait a second, are we really training managers to what they needed? A lot of leadership development became about strategy and all this stuff. Wonderful stuff. But the fact is, if I'm the producer manager, I'm managing, even the branch or 30 branches, I'm not going to set the strategy for consumer, but I have to have impact in the OpEx and all the things. So what do we train them? So we're now taking them through modules about operational process understanding, mapping data to process that sets up AI to work right, frankly, without the data. OpEx, so we really got precise about what the skills you're training. And I think we'll see how it goes, but that was sort of, first was we just have too many managers that talk about bureaucracy. The second was, wait a second, we got to make sure the managers do what they're supposed to do and not try to do other things. And that probably takes much more intentional now when you have less of them, because if you get it wrong, you're going to really screw this up, because there's not that many to go around and they can't make up for it. And then secondly, are they really working on developing their teammates? So if you believe you're hiring for a career, the most the management has to do in that first level management is actually have the career discussion and understand and the talent and what they're doing. That's one of their major jobs. They can't do the job for the person. They got to make sure that, and that then when people leave us, they leave us because they don't think their boss is in it for them. It isn't about money. That's what you found. And so we got to train that skill in the managers better. Some are great at it naturally, some aren't, but we can't leave it to chance. And so management's a process. We spend $7 billion on the Management Bank of America. And we're saying, are we getting what we want for that? It's out of the 30 billion we spend for compensation. 7 billion is just to the managers. And you're going down and saying, are we getting what we want? And we can't leave it to chance. So, and that's a learning that we got. And then the emphasis on process skill, process understanding, re-engineering, etc., idea generation, entrepreneurship within the context of the job description. Again, we got to be careful in a controlled entity. You don't, go places. And it's been fascinating to watch. And that's a journey we're just, on the first 10 miles of the 100-mile trip. And we'll see where, and by the way, the trip may extend beyond 100 miles. We're just trying to get to a place.
Brian, that you provided a great segue to a final question, which again is a big one, and weigh in where you like. But the work we're doing with some very big complex companies like Hire, when they, they're a highly integrated company. They produce products that talk to each other. They're a world leader in Internet of Things. They re-engineer entire huge ecosystems around the world. But they divided their organization up into 4,000 micro enterprises. Everyone has its own P&L. Everybody feels like an owner. And they got rid of 12,000 middle managers. Most of them didn't leave. They got reassigned to these smaller, more entrepreneurial units. But here's what we are thinking about. If you look at the largest companies in the United States, if take away the FANG, take away Facebook, Apple, Amazon, and Tesla, and so on. But if you take the rest, the more traditional top 100 largest companies in the United States, they dramatically underperform the Russell 3000. Dramatically underperform. And those largest companies are now a drag on U.S., and we see this in Europe as well. They're a drag on U.S. productivity. And the one thing we haven't talked at all about is productivity. That's about half today what it was 20 years ago. And unless we get productivity growing again, it's going to be hard to come up with all this money we need to solve these fundamental social problems. And at least for us, at the core of this is bureaucracy. And we estimate, we've done some pretty good arithmetic here. I think it holds up, that an excess of bureaucracy, too many layers, too many processes, so on, costs the U.S. costs the OECD about $10 trillion a year of lost output, about $3 trillion in the U.S. Gallup would add another $7 trillion on that from underutilized human capacity. So like $17 trillion, which if we could like tap into that bank, we would not have a productivity problem. So it seems to us that you have these very large, powerful organizations. I spent my life inside them, working with them, but I wonder somehow we have to turn on the entrepreneurial gene in these companies. We have to get them to dramatically shrink. I mean, our argument would be no organization at whatever size needs more than 3 levels, with the transparency of information and the ability to connect people laterally. So as you think about this journey, you said 10 miles out of 100. Here's a question: How do you think you'll be able to get your colleagues to kind of think radically about where this could lead and where they can imagine that we could change the management model as dramatically over the next 10 or 15 years as we've changed, for example, the payments model, where like none of us are writing checks anymore, very few of us are. So it seems to me that's a fundamental challenge today for CEOs, is how do you get people to really think about how we use this technology, how we can make this shift to organizations that are much flatter, much faster, much more entrepreneurial, and that are no longer kind of a drag on productivity growth. So how do you bring your colleagues along? How do you inspire them with a vision of what that might be?
So let's go to the inspiration first, because it's hard to inspire people about tedious OpEx work, right? But this is a little bit teasing, but you say OpEx is fun. I said everything you like about this company, the $1.5 billion program we did for racial and social justice, the advertising we do, the sponsorships we do, you pick everything like new products, new services, tech spending. It's all because we can drive the operational excellence. We're in a commodity business. There's lots of participants. Pricing is set by a market which gets tighter every day, and customers. I said, so OpEx is fun. It pays for everything we do. Sharing our success with the communities, being what we do on benefits and being placed. So you got to get your teammates to link. If I take $1 out, I get $1 to put it over here, and that's been the mantra we've had is, look, we will spend the money to further push the company, but nobody's going to give us a powder just to raise expenses. We are not like some of these companies. We actually have to make money. We have to actually make a lot of money. And there are other people, even in our industry, aren't making any money and stuff like that. People keep saying, well, they're worth a lot. And you're saying, I don't know how, if you don't generate economic activity, at some point you will or will not be worth it, but that's just something to be said. So, but we say OpEx is fun. That's how you get them to sort of emotionally understand it. You tell me what you like. Benefits, this, that, OpEx drives it. And that's the underpinning of responsive growth. Got to grow, no excuses. Got to grow in a customer focus. Got to do it with the right risk. Got to do it on a sustainable basis. Best place for teammates work, share our success with the community, with our communities. That's our ESG work, and then drive OpEx, because that makes a sustainable business model. So that may not sound inspiring, but it's logical to people.
Unfortunately, though, most managers are fans of everything lean except lean management. That's when you start to run.
No, So now I'm gonna go to the manager thing, and so I created. I I I'm trying to think of the great business thinker generations ago at Harvard. I just lost the name, um, but he said one of the interesting things he wrote was with the advent of the computers, you don't need middle management.
Well, Peter Drucker argued that.
Drucker.
Yeah, yeah, yeah.
I just
Okay.
read on him. So Peter Drucker wrote that. So I gave that article to my team. I said, by the way, I gave it to the middle manager. I sort of said, okay, what is it? What do you think this means? But his point was your point, which is information now travels. So years ago, when the loan officers in the commercial real estate business in the state of New Hampshire made loans, nobody knew what the hell was going on. Now, when a hurricane hit in Houston, and I need to know, the credit card outstanding, I called my colleague and said, what's the credit card? Which zip code do you want? The one that's most flooded or the one next to it? And so think about information and flow. And so I showed them those articles. I showed them sort of the structure. This goes back to those days when I put the top 200 people that managed 80% of the people in the room and said, what are we going to do about this? I said, we can't go on this way. If you want your people to get paid more, if you want more investment, figure out how to get this out of the middle. And that started this process. And then it was sunshine. What I never did, a lot of consultants would come and say is, the span of control of this unit should be 10 or 12 or 15. I said, I don't know what it should be. By the way, I don't want to diminish your appetite. It could be twice as high as I'm saying, and I make a mistake and tell you. So we just started process. And process was they came in, and we said, okay, you come in with every person that has less than 5 direct reports and tell me what they do and what they're doing. I didn't have to ask twice before they start dropping from the screen. And so we keep a bar chart that shows the progress at cost time of the direct reports by 0 to 5, 5 to 10.
Sorry. What happened exactly there, Brian? What did you ask, and then what?
I said they come in every quarter and they show me all their managers at the time that were below 5 direct reports and what they did. The people that manage more than 5 people, and 5 to 7 and 8 to 10 and 10 and above. I said, what do they do? And by the way, it's just all pay-away comparison. The person woke up and said, what, I got this person doing this, I got this person doing this. The same thing, one's got 10 and one's got 5. Something's wrong. And so that started that illumination. So to me, it's sunshine and understanding that what goes out goes back in. And then also going all the way back to the point about the employee survey. If you listen to our survey, as I said to him, this isn't like the old preparation commercial, my friend has a problem. I said, we have the problem. Our teammates are telling us we're the bureaucracy. Our teammates are telling we're the issue. And I said, if we don't fix this, we are never going to have employee delight. Comes down, and the scores of the managers went up dramatically. Because what they weren't doing is fighting with each other. What they weren't doing is going to meetings after meetings. Now, we hit the thing and we kind of plateaued, and now we're turning it back on again and saying, okay, wait a second, why were we going out at this clip and it plateaued? Now, in the crisis, everything slowed down, but now, and by the way, year to date, we're down 500 managers. We didn't do anything except just show people the stats again and say what's going on.
Beautiful story. Beautiful story. Because the ratio today in the United States, I think it's a ratio of 1 manager to every 7 employees, and then if you add in support staff, HR, it's about one manager for every 7 employees, and it's about 1 bureaucrat for every 5
Yeah.
employees.
And
And
we're 11 to 1. We're 11 to 1. We're
sorry.
11 to 1. I get 11.1 to 1.
Okay, that's good.
And I could tell you by every
All
one of my
right.
divisions that
You're already a standard deviation
yeah.
better.
Now, at the time we were at 7 when we started this, and that's what it's to the point. And this sounds like such tedious, sort of stuff, but it was just the sunshine. We did this thing called the icicle chart, and if you were blue, you had more than 10 direct reports. If you were red, you had less. And then the length of the layers were dictated by the icicles hanging down. And you could see these long layers that were thin, so you had to be sort of wider and bluer was better. And the person comes in a chart and they're looking at it and they're saying, I can't come back twice. And you just started grinding. I never said Gary's got to go and Michele's got to stay. I didn't know. I mean, how can you know across all those managers? What you can do is just illuminate. By the way, I can see the icicle chart and go and roll over it, and I can see it is Gary with less than that. But what am I going to do about it as CEO? And so the key is that process which gets people going, and then have it feed off each other, and get the responsible parties in the room said fix it, and they did. And then it takes some coaching and some noodling and things like that. And so the process itself is bureaucratic, but it unleashes a less bureaucratic company.
So Brian, thank you for talking to us today. I think both what you've done on the social side, and then also what you're doing to kind of slowly push back at the inevitability of bureaucratic creep. We call it bureaucrasis. I mean, there's a lot to learn there. I know we've only unpacked it a little bit, but thanks a ton for sharing that and for inspiring people, and like just power to your elbow is all we can say.
No, it's been by the way, I have a wonderful team that does this. So to me, I just throw out the crazy idea and they sit there and say, can we do that? And they go do it, and it's been wonderful. And so we owe all our success to the 200,000 plus talent people, and especially during the pandemic, they've done a great job. So I never want to finish without realizing this was a management team that just did some incredible things because we said we could do it, and that's pretty interesting.